Hello everyone. What actually happens when a company decides to change its counting methods halfway through fiscal year? Or worse, what if we actually uncover a significant error in last year's financial statements? How do we fix this without losing the trust of our investors and stakeholders? The answer to these questions lies in the topic we are going to discuss today. So welcome to our video on PSAK 208, Counting Policies, Changes in Accounting Estimates, and Errors. Now before we dive into PSAK 208, let us introduce ourselves first. Hello everyone, my name is Iska Klafiani, this is IDO 2024 5000 and 7.
And my name is SofianaOkrafiani with student ID 2024 522.
Now before further ado, let's go to the next slide. PSAK 208 replaces PSAK 25 that is issued in 1994, which previously governed over net profit or loss for the period, fundamental error, and changes in accounting policies. With the introduction of PSAK 208, the old standard was withdrawn and is no longer applicable. The new standard provides a more comprehensive and updated guidance on the selection and application of accounting policies, treatment of changes in accounting estimates, and the correction of prior period errors. This update helps improve the consistency, comparability, and transparency in financial reporting. So therefore, PSAK 208 serves as the current accounting standard that guides entities in dealing with the accounting policies, accounting estimates, and error correction in accordance with the modern financial reporting requirements. Now let's move on to the next slide, which is about the objective of PSAK 208. So this PSAK aims to provide guidance on how entities should select and change their accounting policies. It specifies the accounting treatment and disclosure requirements for the changes in accounting policies, changes in accounting estimates, and correction of the prior period errors. The main objective is to improve the relevance and reliability in financial statements. In addition, this also enhances the comparability, which allows us as users to compare financial statements across different periods and among also different entities. And we need to note that the disclosure requirements for accounting policies, other than the changes accounting policies, are addressed separately in PSAK 201 about the presentation of financial statements. Now let's move to the next slide, which is about the scope of PSAK 208. So PSAK 208 applies to the selection and application of accounting policies issued by an entity. The standard governs how entities should account for the changes in accounting policies, changes in accounting estimates, and correction of errors from prior periods. In addition, any tax effects resulting from the correction of prior period errors from the retrospective adjustments related to changes in accounting policies must be recognized and disclosed in accordance with PSAK 212, which is titled Income Taxes, and this ensures consistency and transparency in financial reporting. Now let's move to the next slide, which is the key definitions in PSAK 208. So an accounting policy consists of the principles, rules, and practices used by an entity when preparing financial statements. And the second is that a prior period error occurs when information that was available and could reasonably have been used was either omitted or applied incorrectly. So this error may be a result from the mathematical mistakes, incorrect accounting policy application, misinterpretation of facts, or fraud. The concept of materiality is adopted from PSAK 201 and is the same in the standard. Information is material if omitting, misstating, or obscuring it could reasonably be expected to influence the economic decision of users. That is relying on this financial statement, and we should usually judge the materiality based on the size and the nature of the item. Now let's move to the next slide, which is about the retrospective and prospective application. PSAK 208 distinguishes between retrospective and prospective application when accounting changes happen. Retrospective application requires an entity to apply a new accounting policy as if it has always been in effect. As a result, prior period financial statements may need to be adjusted to ensure consistency and comparability across reporting periods. On the other hand, prospective applications affect only the current and the future periods. This approach is commonly used for changes in accounting table. For example, if a company wants to revise the full life of a machine from 10 years to 15 years, the new depreciation expense is applied only going forward without changing accounts that is reported in the previous year. The standard also introduced the retrospective restatement, which is used to correct the prior period errors. Under this method, the financial statements are revised as though the error had never occurred, which allows us as users to compare financial information on a consistent basis. In addition, PSAK 208 also refers to Mission Individual Accounting Standards, or PSAK, which consists of accounting standards and certification issued by the Indonesian Institute of Accountants and supported by relevant capital market regulations. So these are the two examples of retrospective and prospective application. The example of retrospective application is when we want to change the inventory valuation from weighted average to FIFO and reset the prior financial statement. While the example of prospective application is when we want to refine the useful life of equipment from 10 years to 15 years and reduce the future depreciation only. The example of retrospective statement is that we want to correct a mathematical error that overstated our revenue in the previous year. Now let's move on to the next slide, which is about the impracticable application. PSAK 208 recognized that retrospective application or retrospective statement may not always be feasible. The standard uses the term impracticable to describe situations where an entity cannot apply a requirement even after making every reasonable effort to do so. There are three main circumstances in which retrospective application is considered impracticable. First, the effects of the change or correction cannot be reliably determined. The example is that historical records may be incomplete or unavailable, which makes it impossible to calculate the impact on the prior periods. Second, the application would require assumptions about management intention in the past. Since those intentions cannot be verified objectively, any adjustment could become highly subjective and unreliable. Third, the process may require significant estimates for prior periods, but it may be impossible to separate information that was available at the time from information that became known later. For example, if a company attempts to estimate the fair value of an asset several years after the reporting date, the estimation could be influenced by hindsight rather than actual conditions that existed at that time. In this situation, PSAK 208 allows entities to use alternative approaches instead of forcing retrospective adjustments that may not produce reliable financial information. Now let's move on to the next slide, which is about the selection and application of accounting policies. So PSAK 208 states that when a specific accounting standard applies to a transaction, event, or condition, the entity must follow the standard in determining its accounting policy. The objective is to ensure that financial statements provide relevant and reliable information to users. Also, immaterial items may not require strict application of a policy. Entities are not allowed to intentionally deviate from the Indonesian Financial Accounting Standard or PSAK simply to achieve a preferred financial result or presentation. Compliance with the standards remains essential for maintaining the credibility and comparability of financial reporting. So let's move on to the next slide, which discusses how do we apply accounting policy when no specific PSAK exists. So not every transaction is specifically addressed by PSAK. In such case, management must use personal judgment to develop an appropriate accounting policy. The resulting information should be relevant for users, making recommendation and should also be reliable. Reliability means that the financial statements should fully represent the entity's financial composition and performance. They also must reflect the consistency of transactions rather than just their legal form. They must also remain neutral and free from bias, and exercise modern judgment and include all material information necessary for users. Let's move on to the next slide, which is about the sources used in developing accounting policies. So when a management wants to develop an accounting policy in absence of a specific PSAK, it should first refer to the standards that address similar transactions and then consider definition, recognition criteria, and measurement concepts contained in the framework of the financial reporting. Management may also look at the international accounting standards, other accounting literature, or common industry practice. However, these sources can only be used if they are consistent with the Indonesian accounting standards and the framework we have. Now let's move to the next slide, which is about the consistency of accounting policies. So consistency is a fundamental principle in financial reporting. PSAK 208 requires entities to apply the same accounting policies to similar transaction events and conditions from one period to another. A consistent application will improve the comparability and help users identify trends in an entity's financial performance and their position. Different accounting treatments can only be applied when a PSAK specific permits or requires different classifications, but even then, the starter policy must be applied consistently within each category. Okay. Now let's move on to the changes in accounting policies. The PSAK 208 limits changes in accounting policies because the frequent changes reduce the comparability between reporting periods. An entity may only change a policy if the changes is required by PSAK or if the result in individual statements that provide more reliable and relevant information. The standard also clarifies situations that are not considered changes in accounting policy. For example, if you want to apply a policy to a new type of transaction or to a transaction that was previously material that doesn't constitute a policy change. In addition, the initial adoption of the reversion model for property, plant equipment or PPE or intangible asset is treated under respective asset standard rather than under PSAK 208. For example, they are allowed to change when they want to switch from the cost model to a more appropriate method required by the new PSAK. So what happens when it is considered not a policy change? It is, for example, when a company begins leasing equipment for the first time and applies accounting because such transaction didn't previously exist. The example of the revaluation, which is a special case in this standard, is that a company wants to revalue its land under PSAK 216. And this is treated as a revaluation adjustment rather than the change in accounting policy.
Okay, next we move on to the changes in implementation of accounting policies. A change in accounting policy may occur when an entity adopts a new PSAK or voluntarily changes an existing accounting policy. When a new PSAK contains specific transaction provisions, the entity follows those provisions. If there are no transaction provisions or if the change is voluntary, the entity generally applies the change retrospectively. So retrospective application means applying the new accounting policy as if it had always been in use. Therefore, comparative information from previous periods must be restated and the opening balance of affected equity accounts must be adjusted. It is important to note that early adoption of PSAK is not considered a voluntary change in accounting policy. In addition, when no PSAK specifically applies to a transaction, management may use guidance from another standard-setting body that uses a similar conceptual framework. If that guidance is later amended and adopted, the resulting change is treated as voluntary change in accounting policy. Next, we go to the limitation of retrospective application. So although the retrospective application is generally required, there are situations where it may not be practical. So if an entity cannot determine the effects of the change for specific prior periods, the entity applies the new accounting policy from the earliest date at which retrospective application is practicable and adjusts the opening balances accordingly. If the cumulative effect of applying the policy to all prior periods cannot be determined, the entity applies the policy prospectively from the earliest practicable date. Whenever possible, comparative information should still be restated. Any adjustment relating to periods before the earliest period presented is usually recorded in opening retained earnings or another affected component of equity. This approach balances the need for comparability with the practical limitation faced by preparers of financial statements. Next is the disclosure requirements or changes in accounting policies. So for the initial adoption of a new PSAK, entities must disclose the title of the PSAK, nature of the accounting policy change, relevant transition provision, and their future impact, amount of the adjustment for each affected financial statement line item, and basic and diluted EPS if applicable. Adjustment relating to periods before those presented also needed. An explanation is retrospective application is impracticable, including how and when the change was applied. For the voluntary change in accounting policies, entities must additionally explain why new policy provides more reliable and relevant information. The entities must disclose about the nature of the change, reason why the new policy provides more reliable and relevant information, amount of adjustment for affected financial statement items and EPS if applicable, adjustment relating to earlier periods, and explanation when retrospective application is impracticable. And lastly, when a new PSAK has been issued but not yet effective, entities must disclose that fact and provide information about the expected impact of the future adoption if it can be reasonably estimated. So the relevant information such as the title of new PSAK, nature of the forthcoming change, effective date, planned date of adoption, expected financial statement impact, or a statement that the impact cannot yet be estimated are needed. This disclosure helps users understand the effects of accounting changes on financial statements and improve transparency. Okay, next we move on to the accounting estimates. The accounting estimates unnecessary when certain amounts in financial statement cannot be directly observed and therefore must be estimated. Management develop these estimates using professional judgment, assumptions, and best available information. The examples of these accounting estimates are the expected credit loss allowance, which are discussed in the PSAK 109, the net realizable value of inventory in the PSAK 202, fair value of assets and liabilities in the PSAK 113, depreciation expense of the property, plant, and equipment in PSAK 216, warranty obligation provisions in PSAK 237. To develop these estimates, entity use measurement techniques such as estimation techniques and valuation techniques. The use of reasonable estimates is an essential part of financial reporting and does not reduce the reliability of financial statements. Changes in accounting estimates may occur because of new information, new development, additional experience, and changes in circumstances. Unlike changes in accounting policies, changes in accounting estimates are not correction of error and do not relate to prior periods. So, next we go to the application and disclosure of changes in accounting estimates. PSAK 208 requires these changes to be recognized prospectively. This means the effect of the change is recognized from the date of the change and forward. If the change affects only the current period, the impact is recognized in the current period's profit or loss. But if it affects both current and future periods, the impact is recognized over those periods. So, this changes impacts on the asset liabilities and the equity. The carrying amount of the related item is adjusted in the period of change. So, for example, a revision of expected credit losses may affect only the current year's profit, while the revision of the useful life of equipment affects depreciation expense in both current and the future period. So, entities must disclose the nature of the changes and the amount of the change affecting the current period and the expected impact on future periods when reasonably estimatable. If future impacts cannot be estimated reliably, the entity must disclose that fact.
Now let's move on to the next slide, which is about the prior period errors. PSAK 208 recognizes that errors can occur at various stages of financial reporting, which includes the recognition, measurement, presentation, and disclosure of financial statement elements. Financial statements are considered non-compliant with PSAK if they contain material misstatements. Furthermore, even immaterial errors can become unacceptable when they are intentionally made to influence the presentation of financial positions, financial performance, or cash flows. When an error is identified during the reporting period, it should be corrected before the financial statements are finalized. However, not all errors are discovered immediately. In practice, some material errors may only come to light in the subsequent period, which require us to correct previously issued financial information. For example, if a company accidentally records inventory purchase of 500 million as 50 million, if this mistake is discovered before the financial statements are issued, it should be corrected immediately. But if it's discovered in the following year, the company must apply the prior period error correction requirements under the PSAK 208. Now let's move to the PSAK 208, which is about the retrospective correction of prior period errors. So, when a material prior period error is identified, PSAK 208 requires a retrospective correction. The objective is to present financial information as though the error has never occurred. If the error relates to a comparative period shown in the financial statement, the entity must restate the comparative figures for the period. It allows users to compare financial information on a constant basis. However, if the error occurred before the earliest period presented, the entity cannot simply just adjust the figure. Instead, they must restate the opening balance of the assets, liabilities, and equities for the earliest period presented in the financial statement. This ensures that the complete effect of the error is reflected properly. For example, let's assume that a company discovered that in 2026, the depreciation expense in 2024 was understated by 100 million. If the 2026 financial statement represent the comparative information for 2025, the company must restate these affected comparative figures to reflect the correct depreciation amount. If the error originated before the earliest comparative period presented, the company would instead adjust the operating balance of assets, retained earnings, and other affected accounts at the beginning of the earliest period shown. So, the conclusion is that If the current period error is found now, we just need to correct it before we issue the statement. But if it's found later, we need to do the retrospective correction. But if we found the error in the comparative period, we need to restate the comparative figure. If the error is before the earliest period presented, we need to adjust the opening balance. Now let's move on to the next slide, which is about the limitations of the retrospective restatements. Although PSAK 208 generally requires prior period errors to be corrected retrospectively, there are situations where full retrospective restatement is not possible. This occurs when the entity cannot reliably determine either the effect of the error on specific periods or the cumulative effect across all the prior periods. If the effect on the individual periods cannot be identified, the entity can restate the opening balance of the assets, liabilities, and equity from the earliest period for which reliable information can be get. If even the cumulative impact cannot be determined, the correction is applied prospectively from the earliest practicable date. This approach balances reliability while still with the practicality, while also improving the accuracy of financial reporting. For example, if a company discovers that inventory was incorrectly valued for several years, but detailed inventory records are not only available beginning in 2024, in this case, we can do restatement from 2024 rather than starting from the earlier periods. Now let's move on to the next slide, which is about the retrospective correction versus the change in accounting estimate. So PSAK 208 makes an important distinction between correcting errors and changing accounting estimate. So an error actually happens when information was recorded incorrectly or when available information wasn't properly used. Such errors require the retrospective correction. In contrast, accounting estimates are based on judgments and assumptions about the uncertain future amounts. As new information becomes available, those estimates may need to be revised. These revisions are not considered errors because the original estimate was based on the best information available at that time. For example, if the appreciation was calculated incorrectly due to mathematical mistake, it is an error. However, if management later concludes that a machine will last longer than originally expected, the revision of useful life represents a change in estimate rather than an error. Now let's move on to the next slide, which is about the disclosure requirements for prior period errors. So transparency is an important objective of PSAK 208. Therefore, when a prior period error is corrected, entities must clearly disclose the nature of the error and quantify its impact. Users should also be able to understand which financial statement items were affected and how the correction affects the previously reported amounts. If EPS or earnings per share are reported, the impact on both basic and diluted EPS must also be disclosed. Furthermore, when retrospective restatement is impracticable, the entity must explain the circumstance and describe how and when the correction was ultimately applied. This disclosure helps users avoid the significance of error and its effect on financial reporting. Now let's move on to the next slide, which is about the impracticability of retrospective application. SAK 208 recognized that retrospective application may sometimes be impracticable because the necessary historical information no longer exists or cannot be recreated reliably. In many cases, this may require the estimation, and the challenge is in determining whether those estimates can be based solely on information that was available on the original reporting date. The standard emphasizes that entities must not use hindsight when applying for the retrospective correction. In other words, management cannot rely on information that becomes available after the reporting period or make assumptions about what management would have intended to do in the past. For example, if a company wants to correct a prior period estimate of employees' sick leave obligation, if a severe influenza outbreak occurred after the reporting date, the information about the outbreak couldn't be used when it was constructing the prior period estimate because it wasn't known at the time. The objective of this is to create the original circumstance as faithfully as possible and not revise the past using the knowledge that we gained after it happened. For example, imagine that in 2026, a company wants to correct an estimation made in 2023. If management uses information that is discovered in 2025 to calculate the amount in 2023, this means that he was using hindsight. And PSAK 208 prohibits this because the correction must reflect only using the information that was available in the 2023.
And let's move on to the implementation guideline. So we will discuss a total of 5 examples. So let's just move to the first one, the retrospective statement of an error. So during 2000X2, PT Beta discovered that some products which had already been sold in 2000X1 were incorrectly included in ending inventory at December 31st, 2000x1 as a result, the inventory was overstated by 6,500. Because the ending inventory was overstated, the cost of goods sold was understated by 6,500. This caused the profit before tax, net income, retained earnings, and total equity to be overstated. So originally, the PT Beta reported sales of 73,500, the cost of goods sold of 53,500, profit before tax of 20,000, income tax expense of 6,000, and net income of 14,000. After the correction, cost of goods sold increased to 60,000, profit before tax decreased to 13,500, income tax expense decreased to 4,050, and net income decreased to 9,450. Overall, the correction reduced net income by 4,550, reduced the inventory by 6,500, reduced income tax payable by 1,950, and reduced the equity by 4,550. According to PSAK 208, prior period errors must be corrected through retrospective restatement whenever practicable. Therefore, PT Beta restated its 2000x1 comparative financial statement as if the error had never occurred. This example demonstrates how retrospective restatement improves the accuracy, reliability, and comparability of financial statements. Next, we go to the example number 2, the change in accounting policy with retrospective application. The example is omitted in PSAK 208, but the principle are when an accounting policy changes and retrospective application is practicable, we need to apply the new policy as is have always been used, restate the comparative information, and adjust opening balances of affected equity accounts. The changes in accounting policies generally require retrospective application to maintain the comparability. Next, we go to the example number 3, the prospective application when retrospective application is impracticable. So, like before, the example is omitted in the PSAK 208. But the principles are if the retrospective application is impracticable, we need to apply the new accounting policy prospectively, that is, start from the earliest practicable date and do not adjust the period that cannot reasonably be determined. The prospective application is permitted only when the retrospective application cannot be practically performed. Okay, next we go to the example number 4, the fair value of investment property. An entity, let's call A, measures investment property using the fair value model under PSAK 240. Because of changing market conditions, the entity changed its valuation technique from the income approach to the market approach. So why do we count this as an accounting estimate? It is because the fair value cannot be directly observed. The fair value is affected by the measurement uncertainty. The fair value is generated from valuation techniques, and the estimation requires judgment and assumption. So the change in the valuation technique is a change in accounting estimate, not a change in the accounting policy. So the accounting policy remains the same. That is, the investment property continues to be measured at the fair value. Only the measurement techniques changes. Next, we will move to our last example, example number 5, the fair value of cash settled share-based payment liability. So on January 1st, 2000X0, NTPA granted share appreciation rights to the employee. The liability is measured at fair value using the Black-Scholes Merton option pricing model. The changes during the 2000X1 is when NTPA revised the expected share price volatility, and this input is used in calculating the fair value of the FAR liability. So why do we count this as an accounting estimate? Because the fair value is subject to measurement uncertainty, it cannot be directly observed, it is generated using an option pricing model, and because it requires assumption and judgment. So a change in expected volatility is a change in accounting estimate. The accounting policy remains unchanged. The liability is still measured at fair value, and only an input used in the estimation process has changed. Okay, so that's all from our presentation. Thank you for attention and see you in the next video. Bye-bye.